Pinterest's $9 billion valuation expensive or cheap? That's the question investors are asking as they try to decide whether to buy shares in the IPO this week. IPO values are decided on a relative basis, how they compare with their peers that are publicly traded. But unlike, say, a retailer or manufacturer, Pinterest is somewhat unique to the public market. The site provides various how-tos, decorative inspiration, and recipes, all supported by ads. For that reason, investors are using a basket of companies that are also ad-based when comparing Pinterest's valuation. When looking at enterprise value to 2020 revenue projections, search and social media companies trade on average around 6 times. Because Pinterest also enables users to buy things on its platform, investors are also looking at a basket of e-commerce companies, which trade closer to 4 times. Both baskets are actually a discount to the 8 times projected revenue that Pinterest is seeking. Now, even though the company is targeting an IPO valuation that is lower than its latest private round, that may not mean investors think it's cheap, but they may still be willing to pay that premium for growth since Pinterest's revenue showed gains of 60% last year, guys.
And I guess that's the key in terms of the 8 times the premium that is valued at right now, is that people are willing to pay for the revenue growth, which may not be as high as in the other comps.
Exactly. If you look at the traditional search and social media companies, at this point in the game, they're large conglomerates and they're not growing as quickly. Pinterest is in the position where it may not grow 60% this year. Projections for revenue show that it's about 50% for this year. And so it will slow down over time, but it's still much quicker than other ad-based models that are currently out there.
Lyft is still under 60, hit 57 last week. I just wonder what that does to everybody.
Yeah, it's definitely causing investors and companies to pause when it comes to raising the range. It doesn't mean that they won't do so, but they've learned from Lyft's experience, which raised their price range throughout the roadshow process and then priced at the high end of that range. It's causing investors to wonder whether or not they have more leverage in terms of the pricing discussions that happen, because they can say, you know, look, we're underwater with Lyft. We don't want to pay more for the other things that are on the road. Just because you want to kind of get that last dollar in terms of pricing.
Are you finding from the people you're talking to that it's really a competition between Lyft and Uber, or is it Lyft versus the other IPOs?
What's interesting is that it used to be, especially when both companies were private, that what was bad for Uber was good for Lyft, and what was good for Lyft was bad for Uber. Now we're seeing the opposite to be the case. I actually did an informal poll on Twitter because Lyft was down so dramatically on Friday, and I was curious whether people thought that it was because of something bad that they saw in the Uber filing or something good that they saw in the Uber filing. And overwhelmingly, people said that it was some of the bad aspects of the Uber filing that brought Lyft's shares down. So it is kind of interesting, this dynamic, and I do think that over the next couple weeks, as Uber continues its IPO process, the trading in Lyft is bound to be volatile as news trickles out related to Uber.